Hey everyone, welcome back to Corporate Decoder, the place where we unpack the hidden stories in company filings, and today we've got a real gem that might make your wallet feel a little lighter, or maybe heavier depending on how you look at it. We're diving into a report from CMS Energy Corporation, and it involves quite a bit of financial maneuvering. Think of it as a company making some significant promises about its future, and promising to deliver on those promises with cold hard cash. It's a bit like taking out a big loan, but in a very specific corporate kind of way. So CMS Energy, known for keeping the lights on and the gas flowing, has been busy. This report is all about a new financial arrangement, essentially a big borrowing that comes with some interesting strings attached. They've been issuing what are called convertible senior notes. Now, convertible is the key word here. It means these notes can eventually be turned into something else. Specifically shares of their own stock. Let's talk about the deal itself. CMS Energy just completed the sale of a whopping $1 billion worth of these special notes. And as if that wasn't enough, they also sold an extra $150 million worth because a lot of people wanted in. These notes are basically IUS that the company is selling. They carry a fixed interest rate of 3.125% per year, which they'll pay out twice a year, every May and November. The payment starts in May of 2026. Pretty straightforward interest, right? But here is where it gets interesting. These notes are set to mature on May 1, 2031. That's quite a long time from now. The key feature of these notes is their convertibility. What that means is that holders of these notes have the option, under certain conditions, to exchange their notes for shares of CMS Energy's common stock. Imagine you own a piece of paper that says you are owed a certain amount of money by CMS Energy. Instead of just getting your money back with interest, you might be able to swap that paper with the company for actual ownership in the company itself, represented by shares of stock. So when can this conversion happen? For a while, it is a bit restricted. But after the 1st of February 2031, essentially any holder can convert their notes into stock whenever they want, as long as the note hasn't already been paid back or bought out by the company. This gives bondholders a way to benefit if CMS Energy stock price really takes off. Now, how many shares do you get for your notes? Well, for every $1,000 worth of these notes, you can initially get about 11 shares of CMS Energy stock. This sets an initial price of around $90.61 per S-hair for the conversion. What's really telling is that this initial conversion price is about 25% higher than the stock's market price, just a few days before this deal was announced. This usually means investors are paying a premium because they believe the stock price will go up significantly, making the conversion profitable. What else is in this agreement? Well, if something major happens at CMS Energy, like a big business merger or acquisition, which they call a fundamental change, the people who hold these notes might be able to demand the company buy them back. They'd get their original investment back plus any unpaid interest. This is a protection for investors, ensuring they aren't stuck with notes if the company's situation changes dramatically for the worse. And what about the company redeeming these notes early? They can't just call back these notes whenever they feel like it before May 7, 2029. After that date, they might have the option to redeem them, but only if certain conditions are met, like if their stock price has been performing really well for a good stretch of time. The redemption price would be the full principal amount plus any owed interest. Like any major financial agreement, this indenture, the master contract for these notes, has rules and consequences if they're broken. Typical events of default are mentioned, such as not paying the principal or interest, breaking promises made in the indenture, or if the company runs into serious financial trouble like bankruptcy. If any of these happen, the people who hold at least 25% of these notes can declare them immediately due and payable. This means the company would have to pay everyone back right away. So, how do these new notes stack up against other debts CMS Energy might have? They are direct, unsecured, and unsubordinated. That means they're on equal footing with other similar debts the company has. Imagine a stack of IOUs. These are pretty high up on the stack, meaning they get paid before any debts that are specifically ranked lower. This is important for understanding the risk involved for the note holders. This whole deal was done as a private offering, meaning they didn't sell these to just anyone. They sold them to what they call qualified institutional buyers under specific legal rules. That is a fancy way of saying they sold these notes to big, sophisticated investors who are expected to understand the risks because they're professionals. They're not registered with the public initially, which is a way for companies to raise capital quickly without going through a lengthy public registration process. And how many shares could this eventually mean for the company's stock? If all these notes were converted into stock, it would add up to about 13.8 million shares. This is a significant number and could dilute the ownership stake of existing shareholders if or when this conversion happens. Dilution means that each existing share will represent a smaller piece of the company. Looking at this filing, CMS Energy is essentially raising a large chunk of cash through debt that has the potential to become equity down the line. This is a common strategy for companies that believe their stock price will rise. It allows them to secure funding now at a relatively low interest rate, and if the stock does well, they can effectively pay back that debt with their own shares, which is often cheaper than paying back with cash, especially if the stock has appreciated significantly. From an investor's perspective, these convertible notes offer a blend of safety and potential upside. You get a steady income stream from the interest payments, and if the company's stock soars, you can convert your debt holding into a profitable equity position. However, there is always the risk that the stock doesn't perform as expected, leaving you with bonds that are paying a relatively modest interest for a long-term investment. For CMS Energy, this move suggests a strong confidence in their future growth prospects. By issuing convertible debt, they're signaling to the market that they expect their stock price to climb. It is a bet on themselves. The risk for the company, however, is that if their stock price languishes, they'll be stuck paying interest on this debt for the next 7 years, and they might not get the benefit of converting it into equity at a favorable price. In conclusion, CMS Energy is making a substantial financial move here, leveraging the convertible debt market to fund its operations and growth. It is a sign of ambition, but also a clear indication of the financial tightrope they're walking. The real story here will be how their stock performs over the next few years and whether those initial conversion prices prove to be a great deal for the note holders or a costly one for existing shareholders. Alright, that is our breakdown of CMS Energy's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description for more discussions, and thanks for watching. See you next time.